Alright traders, welcome to my channel. This is CJ Profit FX. Okay, today I want us to discuss the difference between inducement and liquidity. Some of you have been asking this particular question in my DM. I said to make a YouTube video for you to understand how inducement and liquidity relate and the difference. Okay, when we talk about the similarities, we talk about the difference. So that's why we are here. Okay, before then, I would like to differentiate inducement from liquidity. When we talk about inducement, we are talking about trap. We are talking about conviction. What convinces you to do something? What attracts you to do something? Okay. Liquidity is attraction. Sorry, inducement is an attraction. These are things that attract traders to make decisions that are not meant to. Just like you trying to buy at a zone whereby you are not meant to. Okay, that's an inducement. And when we discuss liquidity, or when we talk about liquidity, liquidity has to do with your money, your capital. So traders came into the market with the hope of buying and selling. At that moment, they are coming with their money. So that's induced, that's liquidity. You and I are liquidity providers in the market. Automatically, we provided liquidity into the market. Whereas inducement is you as a trader making a decision in a zone where you are not meant to make a decision. Okay, but for you to understand this inducement, inducement plus inducement plus inducement plus inducement equals to high volume of liquidity. Okay, just to tell you that when there is a much inducement in an area, just know that it have generated much liquidity in that area. Okay, before then, I would like to use a chart to illustrate this. But before I do that, I would like to tell you this. As a trader, you should know by now that any turning point of the market contain liquidity. Like every turning point of the market contain liquidity. So follow me step by step as I take you into the charts so you can see how this thing works. Okay, for instance, let's say we have a structure like this. Okay, at this structure, we all notice that this is an uptrend. Here the market is going in an upward direction. So and you notice one of the in fact you know the characteristics of a good uptrend where it will be breaking out structures and creating a lows. So at that point, let's say this area is our breakout structures and this area is our breakout structure and this area is also a breakout structure. Now in a normal sense, we know that when market breaks structures, it have taken liquidity at that side, which means if market breaks structure, the previous high that the market took out is an area that contains liquidity. That is, liquidity has been taken out from the high. So just to tell that market take out liquidity and create liquidity. Do you see it? All these areas I just mapped are liquidity areas. The same thing apply here. These are liquidity areas too. But the difference there is that the market have taken out the liquidity that is being packed at this highest point. So the market create this area as an inducement. Okay, as an inducement, and it have not been taken out. So at this spot, let me tell you the difference now. The difference here is that the market now make a high, taking out structures. Why it creates a low? Why it retraces? Now somebody can ask you, what or how do you identify inducement in your chart? To me, when there is a pump like this, any pullback that doesn't take out the previous low is an inducement. Let's say the market move like this. So for this man to remain here is a trap or is an attraction. So it doesn't take out this previous low. Automatically this area becomes an inducement. So any low that doesn't take the previous low is an inducement, or any high that doesn't take out the previous high is an inducement. But remember when I told you guys that every turning point of the market contain liquidity. So now let's move back. Let's move back, guys. So in my previous structure where I have uptrend and the market is creating a series of higher highs and higher lows. When market move, it take out structure and create inducement at the upside. That inducement is a zone whereby other traders make a buy decision. Okay, everybody is waiting for the market to come and react at the previous low, but the market make another demand zone nearby instead of coming down to mitigate this area. So this area now is an inducement. The same thing applies here. This area is an inducement. This area is an inducement. Okay. Previously, this area is a high that contained liquidity, but the market have taken it out while trying to make a further move. So we call it break of structures. So break of structure is a previous high that contained liquidity, but since the market have taken it out, it's no more valid. So market have taken out liquidity at the upside and then brought them down to the downside. Sometimes you hear traders saying the market move to where there's liquidity. Have you tried to digest that statement to know what it means? Markets move to where there's liquidity. Now, how do you identify that, or how do you know that there's liquidity at that zone? For you to know there's a liquidity at that zone, you must have much inducement like this. So if markets keep on creating inducement at the downside, it's likely tell you that the market will come back for all these turning point that is created at the downside while making an upward movement. So at that point, any turning point contain liquidity. Then how do you know the liquidity that the market will attend to? That's when inducement comes in. So in a simple sense, inducement is also a liquidity, but it have not been mitigated. So let's go to our chart. Let's go to our chart. Now, let's take for instance, we want to make a decision at this point. We have this area as our protected low, which the market has not mitigated. This is our protected low. And in that our protected low, the market make a move that take out this structure, which is we have a break of structure here. Okay. Remember, this is 4 hours time frame. We still have another break of structure here, but it's not that much. It's not, although let me say in a smaller picture. Okay, we have a break of structure. Then if you want to consider an inducement areas, this is an inducement area. This is a turning point or is a pullback that doesn't take out the previous low. So this is an inducement. And we still have all these areas. All these small areas are inducement area. All these small area are inducement area because they are turning point in the market. So for you to understand the meaning of this inducement are those areas or zone whereby impatient traders make decision. Okay, they are zone whereby impatient traders make decision. At that point, the market will go up. But if those impatient traders are unable to take profit when they need to, the market will likely reverse and sweep all the liquidities and sweep all those inducement areas. So in a simple sense, inducement plus inducement plus inducement plus inducement equals to high volume of liquidity. Equals to high volume of liquidity. And anytime you are trading a structure and you notice that at the opposite side, it's creating much inducement, always think twice that the market might likely come back to take out all those inducement areas. Okay, because those inducement areas contain money. Traders make decision at that zones. So for you to be a good liquidity trader, anytime you are trading, make sure you spot out an area that contain a huge liquidity in which the market might likely react. Okay, it's very very important as a trader you try to spot out liquidity in your market. The liquidity are inducement area. So if somebody want to buy, traders like me, I might be like, okay, let me come to this zone and make a buy decision. I set my stop loss below this low, then I extend my TP to the upside. So at this point, I might expect the market to go down like this, then trigger my entry and then move to the upside. Do you guys see it? At that moment, when the market is coming down to pick this my entry, do you know that all the inducement packed here have been taken out? So guys, try to understand where market keep the major liquidity, but try to know that all the turning points of the market contain liquidity. And for you to understand the statement that says market move to where there's liquidity, you need to understand what we call inducement in the market. Because much liquidity in the market, sorry, much inducement in the market create a high volume of liquidity. And market might likely try to go and take out those liquidity so that the market will be balanced. Because if the market doesn't take out the liquidity, that's imbalance in the market, and the market can never move as it's like can never move well, and it's not suitable for traders. So guys, thank you for tuning in with me today. I remain your coach CJ Profit FX. If this is your first time coming to my channel, please click the plus button, subscribe, turn on notification bell so that when I drop videos like this, you can get notified and you watch it and gain more knowledge in the market. Remember, this particular channel is for educational purpose only. Thank you guys.